Pro John Ag here. Oil just blew up. The price of Brent crude didn't just go up in less than a week, it went up by more than 25%. A few days ago, the market was trading at a tranquil $72 a barrel. Then war made the news, and oil prices shot up to $90 and even $91.89 a barrel for a short time. That's not a normal thing to do. That change isn't quiet. That's a shockwave. Analysts are now whispering a number that should make every investor sit up straight. $150 oil. Now here's the big news. The Strait of Hormuz is the short strip of water that started this whole chain reaction. A little passageway in the Middle East that carries almost 20% of the world's oil every day. Think about that. One point of failure. One flashpoint in world politics. One artery that keeps the whole world economy going. And right now, that artery is under a lot of stress. There have already been attacks on several tankers in the area. The cost of insurance for ships that go through the corridor is going through the roof. Shipping businesses are taking their time. Energy dealers are in a frenzy. Now put the pieces together. If ships stop going through Hormuz even for a short time, the oil supply doesn't just get tighter, it locks up, and the market is aware of it. That's why traders quickly bought oil futures. That's why everything got so crazy. That's why the whole energy complex suddenly appears like it has power. But what about the mainstream story? Oh, they're keeping everything nice and tranquil. This is merely a momentary rise, according to the news. A response that lasts a brief time. Nerves about war that will go away. They say that inflation could go up a little. The markets will settle down. That's the story being told. But here's the question that no one wants to ask. What if oil doesn't stop at $90? What if it goes up to $120, $130, or even $150, which is what energy ministers are already warning about? This isn't a momentary surge anymore if that happens. It's a bomb that causes inflation. And history has already told us how this will turn out. During the oil crisis of 1973, oil prices didn't only go up, they went up 4 times. The shock made the world economy weak. Inflation shot up all over the industrialized world. The value of currencies went down. Governments rushed. And what occurred next? Not only did precious metals go up, they blew up. Gold went up in a curve. Silver followed with rapid momentum as investors fled decreasing purchasing power and hunted for anything real. This is the truth about commodities that most investors don't know. Everything is built on energy. When oil prices go up, transportation expenses go up too. Transportation expenses go up, and so do manufacturing costs. Costs of making things go up, and everything else in the economy goes up too. But this is when things become really fascinating. When energy prices go up, the effects don't just end at consumer products. It goes right into the chain of production for goods. Diesel powers mining machines. Electricity powers processing plants. It takes gasoline to ship metals across oceans. The cost of every step in making metal goes up. Now think about what that means for silver. Silver is more than just a shiny way to hold value. It's one of the most important metals for industry on Earth. Panels for solar energy. Vehicles that run on electricity. Semiconductors. Electronics of the highest quality. Silver is needed for all of the technologies. So when energy prices go up, the cost of making silver goes up too. At the same time, demand from businesses keeps going up. The supply gets tighter. Prices do ultimately change. But this is where the psychology of the market gets complicated. Fear is creeping across markets all throughout the world right now. Stocks and airlines are losing money. Transportation industries are having a hard time because of high fuel expenses. Asian stock markets just endured its worst week since the pandemic started. While whole sectors are falling apart, energy stocks are going up. Investors are rushing to change their positions. Money is slowly moving toward goods, to oil, toward physical resources that can handle a sudden rise in prices. But what about retail traders? They're doing what retail traders always do. They get scared. They read headlines of war. They observe things change. They notice red numbers flashing on their screens, and their gut tells them to get rid of their assets and sit on cash. But here's the truth that makes me uncomfortable. Inflation destroys cash first. As regular investors move their money into dollars, the larger players, such institutions, commodity desks, and sovereign wealth funds, do the reverse. They build up, they hedge, they lock in real assets before the next round of inflation starts. And in the past, when energy shocks hit the world economy, precious metals always followed. But something more crazier is going on right now. Because the news is full of stories about oil and the stock market is obsessed with war, nearly no one is paying attention to what's quietly happening in the silver market itself. When you look at the supply side of silver, including the vaults, delivery, and paper contracts, you start to see that something doesn't make sense. Something that makes me think the real tale hasn't even begun yet. While investors are paying attention to oil, something weird is going on in the global silver supply chain. And that's when this story starts to turn scary. Because if you follow the trail into the silver market, everything starts to seem like a crime scene. Here's the kicker. Most people who invest think that making silver is like making gold. Mines dig it up, clean it up, then send it to the market. Easy, right? Not correct. About 70% of the silver in the world doesn't come from silver mines. It is a byproduct of mining other metals, primarily copper, zinc, and lead. Think about what that means. Silver production goes down when a copper mine closes. If zinc mining slows down, there will be less silver. Companies don't always mine silver because they desire it. They mine it because they want other metals. Now put the pieces together. The cost of energy is going through the roof. In just a few days, oil prices shot up by more than 25%. Mining operations depend on diesel fuel. Big trucks, excavators, crushers, generators, all of the tools and machines used in mining need power to work, and the cost of energy just went up a lot. Mining businesses don't just accept that cost without saying anything. When fuel prices go up, margins get tighter. Budgets for exploration get smaller. Projects to expand get pushed back. Mines that cost a lot of money suddenly stop making money. This is what normally happens next. Companies slow down making things. Some mines are closed for a short time. Some people put off starting new endeavors altogether. And because these base metal businesses are linked to silver production, the supply chain gets tighter faster than most people think. Now, picture that happening, while the need for silver in industry is going up. Think of solar panels, electric cars, electronics, and military systems. Demand stays the same, but supply is limited. That's not a good balance. But this is when the story becomes much worse. Because the price of silver you see every day on your screen, moving real silver between buyers and sellers, doesn't set that price. It's written down. Futures contracts traded on exchanges like the COMEX are what set the global price of silver. These contracts are supposed to be about silver. In reality, they are bets on money. Traders buy and sell huge amounts of silver futures without ever actually touching the metal itself. Now here's the uncomfortable number. Analysts say that at some instances, there can be more than 100 paper ounces of silver traded for every ounce of genuine silver that can be delivered, 100 to 1. Think of a bank selling 100 tickets to the same gold bar in a vault. The system works as long as no one comes to get the gold. But what if a tiny number of those ticket holders want delivery at the same time? The whole thing starts to shake. And that's why the silver market is so interesting, because it is always in a state of conflict between the amount of paper available and the real world. Now the bad guys come into the story. Small investors don't control the silver futures market. Big banks with lots of money and big derivatives departments run it. When people talk about this market structure, they commonly bring up J.P. Morgan Chase and BlackRock. These places don't only buy and sell silver. They affect liquidity, the flow of derivatives, and huge futures positions that can change prices in seconds. For a long time, people who don't like the system have said that these institutions employ big short positions and derivative structures to deal with the ups and downs of silver prices. In simple terms, they can swamp the futures market with paper contracts, which can depress prices even when demand for real goods stays high. Now think about the cycle. Selling paper is now a thing. The price of silver lowers quickly. People that invest in stores are scared. There are big headlines concerning a metal crash. But what's really going on? Metal changes hands without anyone noticing. Long-term investors, businesses, and institutions buy actual silver while prices are low on purpose. It's a trick, and it's happened before. When the financial crisis hit in 2008, silver prices fell sharply at first. Retail traders got out of their positions. But as things calmed down and central banks started putting a lot of money into the system, silver had one of the biggest price increases in commodities history. Then it happened again when the COVID-19 market crashed. The markets crashed in early 2020. As investors rushed to get cash, silver prices fell sharply. But within a few months, as stimulus measures spread across the world's economies, silver shot higher, eventually tripling from its panic lows. Same thing. Bring down the price of paper, scare people, get the genuine asset. Now things get more mysterious, because something strange has been going on in the silver market lately. The way people want things is changing. Supply chains are getting shorter, and the biggest indications don't come from trading desks in New York. They come from the other side of the world. The biggest hint that something major is coming doesn't come from Wall Street. It comes from Asia. Because the silver market isn't only a place for Westerners to play anymore when Asia gets involved. Here's the kicker. China and India aren't just buying things for fun. They're hoarding them for a reason. Gold? Check. What are energy commodities? Check. But silver is becoming an obsession that no one talks about. There is a huge need for industrial goods. Silver is needed for many kinds of new technologies, such solar panels, electric vehicle batteries, military electronics, and AI infrastructure. And here's something the mainstream media won't tell you. If energy prices keep going up, mine output slows down, and silver is primarily a byproduct of other metals, the supply shortage in Asia might make COMEX's paper game look little. Now put the pieces together. Tensions in the Middle East aren't just political theater, they're a supply chain bomb. It's not simply a headline that oil prices hit $90. Trucks use diesel, smelters use power, and the machinery that digs silver need fuel. Every time a drone strikes an LNG station, every time a tanker is attacked in the Strait of Hormuz, and every time shipping insurance costs go up, it all slows down mining. Mines put off production, expansions are put on hold, and enterprises that cost a lot of money are shut down. The ripple effect affects every part of the world's silver supply. This is where things turn scary. While energy merchants are freaking out, and Western investors are arguing over paper silver contracts, the real buildup is happening quietly in Asia. Analysts who keep an eye on physical movements say that Shanghai premiums are getting much bigger, which means that real metal is leaving COMEX vaults and going east. Central banks, especially in China, have been adding to their gold holdings for years. Now, though, many people think that silver is being secretly added to as well. This is happening because fiat currencies are losing value, geopolitics are becoming more complicated, and people are fighting for real assets. The US dollar is starting to feel the heat. Think about it. Oil prices are going up to $150 a barrel, inflation is going up over the world, and industrial metals are getting harder to find. Countries that rely on energy imports begin to wonder if it is smart to only use dollars for trade. Trade settlements, reserve allocations, and strategic stockpiles are moving away from the dollar, which slowly weakens its power. Wall Street still calls this transitory volatility, but it's not. It's a big change in the power of commodities. And the numbers are getting louder. There are warning indicators all over the place. Physical silver leaving vaults in Europe and the US, Shanghai premiums at their highest levels in years, Asian ETFs growing with new money, energy costs going through the roof, and central banks quietly buying. But here's the wrinkle that most analysts miss. This isn't just about how much industry needs it or how much energy costs. It's about who controls the world's financial leverage points. Whoever owns the silver may set prices, protect themselves from inflation, and have a say in the development of economies that depend on technology. The East isn't simply buying. They're getting ready to take over in a world where the dollar's power is fading. Now picture the chain reaction. Energy crisis, mine limits, silver supply tightens, Asia builds up physical, COMEX paper contracts under pressure, Western markets weak, inflation rises, U.S. currency credibility challenged. When you add in energy shocks, supply shortages, and the threat of a global debt tsunami, you start to realize the actual threat. the oil boom, the Middle East war, and the quiet buildup in Shanghai are all signs that a big crash is coming that might reset the world's markets. It's not a matter of whether silver will go up in value, it's a matter of when. And the numbers that back up this scenario are scary. Trillions of dollars in debt, interest rates rising, bond yields hitting historic highs, and inflationary pressure that could make the 1973 oil crisis look like a walk in the park. Which leads us to the bit that no one wants to talk about: how the global financial system is on the verge of falling apart, because the world debt clock is moving quicker than anyone wants to admit. According to OECD estimates, governments will borrow $18 trillion in 2026 alone, with the US and Japan making up about 80% of it. Trillions on top of trillions, rising refinancing pressure, and rising bond yields. The economy is a house of cards built on promises made on paper. Here's the kicker: every dollar borrowed makes inflation worse, and every time oil prices go up, it gets even harder to pay off that debt. Central banks are stuck in a vice. When interest rates go up, economies come to a screeching halt. Companies go bankrupt, mortgages go bad, and stores go out of business. When rates go down, inflation goes up, which lowers the value of money and wipes out savings. The Federal Reserve is stuck in this impossible balancing act. History is pretty clear. When debt is this big, every policy decision is like playing Russian roulette. Now, throw in the energy shock. Oil that just went over $90 and might easily reach $150 barrels costs the globe more than gasoline. This makes transportation, food, and manufacturing expenses skyrocket. Supply chains that were already stretched by political tensions are breaking. Some sectors that depend on energy are suddenly paying 2, 3, or even 4 times as much. This affects the prices of goods, including silver. Silver isn't just a dazzling metal, it's the lifeblood of the modern economy. It powers every solar panel, electric vehicle battery, every piece of military technology. When energy prices go up, mining slows down, and demand from industry goes through the roof, silver is the best hedge. It's not a guess. It's a matter of life and death. Let's talk about what could happen, and this is where it becomes real. Scenario 1. Normal market. Silver goes up slowly as investors buy small amounts. The markets get used to the shock, and the paper system stays in place. This is a safe, dull story, but the elites don't want you to see it. Scenario 2. Commodity supercycle. Energy shocks start a bull market in metals that lasts for years. Silver is worth more than $30, $40, or $50 because demand from Asia, electric vehicles, and solar panels is too high for supply to keep up. Institutional buildup is speeding up. Written contracts are no longer useful. This is a slow, steady transfer of wealth. Scenario 3. Financial crisis. Trigger. Bonds go up, interest rates go up, oil goes up to $150, and inflation goes up. People panic in stores, the stock market crashes, and the price of silver goes up overnight as people around the world look for a safe place to store their money. Physical demand is too much for paper markets. Vaults are empty, and the financial system is on the verge of collapse. Trillions of dollars disappear in money, but real assets like silver, gold, and energy stay safe. This is the scary part. History repeats itself. Real assets usually prevail when governments create money and conflicts mess with energy, like in 1973, 2008, and 2020. Bonds break down, currencies lose value, and paper contracts disappear. The message is harsh but clear. Physical assets are power, and silver is the weapon of choice in the next financial conflict. And the last question isn't will silver move? That's how violently will it move? The charts, the premiums, the vault data, the energy crisis, and the global debt bomb all lead to one thing. This is when safe havens become tools for survival. If you believe this is just scaring people, look at the numbers. $18 trillion in debt, $91 for oil now, $150 for oil tomorrow, silver shortages, and Asian accumulation rising quickly. The system is at its limit. Wall Street may label it transitory, but the truth doesn't wait for news. So here it is. In a world full of debt, inflation, and political unrest, silver isn't simply a trade. It's the one thing that can save a system that is falling apart. Whoever has it has influence over leverage. If you disregard it, you lose everything to fiat erosion. There is a war going on for energy. The paper markets are a scam, and the next silver explosion is coming faster and harder than anyone thought it would. Your turn. Stack, lock, and hedge. There is no way to reset the system once the dominoes fall, and those who are left holding cash will not be shown any mercy.